let's get back to Grant White, Portfolio Manager and Investment Advisor at IA Private Wealth. Thanks very much for joining us once again. You are an investor in RBC. Any particular thoughts on what the impact will be for the bank?
Yeah, I mean, as Christine was saying, I mean, I think this is a good deal for RBC. And I think that, as an investor in RBC, and we own it in our portfolios for our clients, this is a good deal. The rich somewhat get a little bit richer here. I mean, you've got the largest lender in the country, and they just bought up the 7th largest lender. And so it gives them obviously access to especially, you look at the markets that HSBC was heavier in, it gives them a little bit more access in those areas of which they were already strong, but they just got a little bit stronger. So, all in, as a shareholder of RBC, we love the deal. We think it's good and happy to continue to be a shareholder.
You do say there's a public policy question here, though, that there should be room for rival startups to compete in the banking sector.
Yeah, no, absolutely. See, as an RBC shareholder, I love the deal. As a Canadian, I think that, we need to be very critical of competition in all of our industries, but, banking in particular, which is so heavily concentrated. And, I don't mean to get, I won't get political on this, but what I do think is that competition is good for pricing. And we have seen that in HSBC, where they have been influential on especially mortgage lending rates and other areas like that. So there's certainly a concern that we are not seeing that. On the other side of that is that I think that the Canadian industry should be more open to new and innovative solutions. I mean, we have a tremendous amount of talent in this country with entrepreneurs and startups. And I think that the banking sector is largely closed off to a lot of that today. It's just, the gates are too hard to break down. And so I think that the government should be actively looking at ways to inspire and ignite new innovation and new startups in the financial services area.
When we saw those couple of U.S. regional banks failing earlier this year, I mean, nobody particularly wants to see banks fail, but I did see suggestions that U.S. banks are inclined locally to take more risks than our big lenders.
Yeah, I think so. I mean, and it's an interesting case to bring up. I mean, I think that can be easily measured and easily controlled in our system, while still allowing for more competition. And I think so far, actually, we've seen a good job of that. But I do think that we need to be critical when you see big deals like this. I mean, the timing of it is also kind of interesting, given where we are and with inflation and the cost of living prices that have gone up over the last couple of years, and the cost of lending that has gone up. And so I think this is all bringing it a little bit more to the forefront for Canadians. But in saying that, yeah, I mean, it's not a bad thing that, we might have some smaller banks or some more scrappy institutions that are open to taking on some risks, as long as it's measured from an overall industry perspective.
Yeah, I mean, it's capitalism, I suppose. If a bank does do riskier lending, it should disclose that properly. A smaller bank, disclose that properly to its shareholders and, have at it. If the bank fails, it fails.
Yeah, absolutely. I mean, at the end of the day, I mean, investors have a choice, right? And so, I mean, I think if a company wants to be a little bit more scrappy or maybe try to be a little bit more innovative, then that's a good thing, because it will lead to new solutions that perhaps the bigger banks just aren't willing to try.
Yeah, the costs of oligopoly are hard to measure, of course. I do remember Economics 101. I loved that course. Not that I remember very much of it. What is your attitude to investing in the banks generally, Grant? They have been under pressure over the past year. There are ongoing fears that we could see mortgage defaults, for example.
Yeah, it was a tough year up until the beginning of November, and then we've seen an incredible increase, and especially in a number of our banks. I think that people need to be realistic about where the Canadian banks are going to go going forward. I don't expect to see massive gains. We are shareholders in RBC, as I mentioned earlier. We plan to continue to hold RBC. We like it from just a pure core holding perspective. But I think if you're looking for real growth, I'd still be looking other places. I think we've seen the easy growth in this space, and as you pointed out, Andy, there are going to be challenges, certainly to the banks as the entire interest rate story continues to unfold into 2024. So, again, I like banks as a core holding, but I think investors should be realistic. I don't expect a 30% return there. I expect steady growth.
What are your clients telling you? Are some saying, Grant, just put me into GICs, man, I can get a decent return? Are you getting clients wanting to make that move?
Yeah, I mean, it's interesting because, our financial plans used to say like we only need 4.5 or 5% to be successful. And now you can get that on a guaranteed basis. I think we are getting some of that, but it's also, the levels go up. I mean, if the risk-free rate is around 5, then, we expect to earn more in other areas, whether it's our bonds or our stock holdings. And we are still very much in a recovery phase from last year's market. And so I think that investors need to resist the temptation, not that GICs are a bad thing or even just, even a high interest savings account for that matter. I think they have a place in a portfolio, but I think that, you need to resist the temptation to try to just batten down the hatches, because I think there's a much broader recovery in the markets yet to come. And it's likely to play out in the next 12 to 24 months. And you want to be invested throughout this. It's going to be volatile. We've seen that. So I expect it, but, I think you want to be participating.
Do you get people who say, look at the big dividend yields on the likes of an Enbridge or some of the telecom companies, of course, BC is our parent company, and say, well, just put me into those because I'm locking in that dividend yield for forever, as long as they don't cut?
Yeah, well, you bet. I mean, I think there's a lot of dividend chasing going on right now, especially. And, not that long ago, Bank of Nova Scotia was at around a 7% dividend. So we saw a lot of that. And I think that's going to continue on. That's pretty natural. What I often talk to investors about is, dividends are nice. But a dividend is really just that company returning back the money to you that they don't have any real better ideas for. If they had better ideas, or if they could buy back their shares at a lower price, that's what they should be doing with that money. Now, it's a little bit different when you come to like a Canadian bank, for example, because the reason you buy them is because of largely because of the dividend. And so I don't expect the banks to do anything different. But I would be cautious around buying any company just because of a dividend. Really, I love companies that have so many good ideas that they don't pay a dividend. They're just reinvesting back into their business for the most part.